Hello everyone, this is Christian Rana with Rana Property Group, and today I'll be walking through our multifamily development screener model. And before I begin, I'll share a little bit of background about who we are. So we are a real estate agency and investment consulting firm based in New York City. Our brokerage side specializes in New York City real estate, and our non-agency side consults investors on deploying capital in real estate across the globe. Our mission is to democratize institutional quality analysis for all real estate investors. So whether you're a first-time investor looking to do your first deal, or a family office or real estate private equity fund with hundreds of millions, if not billions of dollars of capital to deploy, we're here to help you streamline that process and deploy your capital effectively. Our mantra is we make deals come true, and to date we've worked on engagements totaling over $1 billion. And we cover all major asset classes, strategies, and both sides of the capital stack. So we've worked on deals in the multifamily, hospitality, retail, and self-storage spaces, in addition to core acquisition, so purchasing stabilized assets, to even development and repositioning and affordable housing deals as well. And then lastly, as I mentioned, both sides of the capital stack. So whether you're looking to be a debt investor or an equity investor, we can assist you in making that capital deployment as well. Jumping right into the model, this is our multifamily development screener model. And we had a very simple motivation for building this model, and that is we wanted to be able to quickly assess the viability of a multifamily development deal. So this model is ideal for preliminary underwriting, and it serves as a middle ground between the back of the napkin analysis and the more robust financial analysis you can expect to find at the end of an acquisition process. And so the model is split into two sections. We have the operating assumptions and investment summary section, and beneath that, we have the pro forma and cash flow summary. And so all of the model inputs are housed here in this operating assumption section, and the model also only has two tabs. So whereas we've created models where we're dealing with 20, 30, even 40 tabs, this model only has two. And again, the reason for that is we're looking to democratize institutional quality analysis for all real estate investors. And so we recognize that there are varying degrees of comfort when utilizing Excel. And so this model addresses that issue effectively because all of the inputs here are in cells with blue background and blue text, and changing this will update the model accordingly. There's no need to go building out the model on your own, unless of course you have the capability or you have the necessity to augment this model for any purpose, which of course would be fine. And so for that reason, even though the Calcs tab has no inputs here, we left this here because we didn't want the model to be a black box. Yes, we could have hidden this tab, but we do recognize people usually want to incorporate something to the model or maybe get rid of something, make it simpler, and so we left that functionality in here as well. And so the Calcs tab is here for your auditing purposes as well, if you just want to make sure things are calculating correctly. So we have the investment assumption section as well. So here we can input the acquisition date, and we have the disposition month. So this model does allow you to choose when you exit the deal based on the month, as opposed to being limited by exiting in year 4, 5, 6, for example. And we have the corresponding disposition date, which is a function of the acquisition date and the disposition month. We have the ability to choose the exit cap rate, and then we have our NOI method, which will of course be applied to the exit cap rate to determine your sale proceeds. But in particular, the NOI method here, you have four options. So forward 12, trailing 3, which will take the previous 3 months. So we're looking at month 60, it'll take the previous 3 months and multiply that by 4, or annualize. So it'll take month 60 NOI and multiply by 12. So that'll be your in-place NOI at month 60. And then of course we have the sale closing costs. We have our leasing schedule here. So lease up start, the amount of time it'll take to lease up the property, and when the property is actually leased up. In other words, this is stabilization. And based on these inputs, we also arrive at lease velocity. So for this particular deal, we have our unit count, which is 48 units, and the lease up period is 12 months. And so our lease up velocity is going to be the number of units divided by the lease up duration, the lease up period here. And so we have 4 units per month. Then we have cap rate at stabilization. And so cap rate at stabilization here is going to drive our development spread chart here. So if I change this to something more conservative, such as 6%, for example, this will update our development spread. And so we see our development spread has decreased since our market cap rate is up. And we see we're able to juxtapose the market cap rate to the stabilized return on cost. That's how our development spread is calculated. So changing this back to 5%, for example, and we see the model has updated accordingly. Beneath the leasing schedule, we have the construction financing assumptions. So we're able to input the loan to cost ratio here. And right now we're running 65%. And we see that populating in the sources and uses table here. We have the interest rate, capitalized loan fees, and exit fees. And so here we have our permanent financing assumptions. We have a toggle whether you want to refinance the property or not, because we recognize some developers want to build the asset and will sell it to another player who will do the lease up and operate the asset. We have the refinance month as well. And so where in some models the refinance is assumed to occur at property stabilization, so the lease up end, we wanted to maintain the functionality in this model to choose the refinance month in the event that you feel that you may not be able to obtain financing right at stabilization. This does allow for that buffer. And speaking of which, going back to the leasing schedule briefly, this model also does allow for pre-leasing, meaning right now the lease up start is in month 19 and our development ends in month 18. So if I wanted to incorporate pre-leasing, I can do so simply by making the lease up start earlier than the end of the development. So I could change this to month, let's say 17, for example. And so pre-leasing will start 1 month before construction ends. Going back down to permanent financing. So we have the refinance month. I mentioned that. NOI method. So we have, again, the NOI method with those 4 aforementioned methods of calculating the NOI. And we have our valuation cap rate. So this is the cap rate that a lender will use. And so we can change that here. And again, we wanted this to be different than the cap rate at stabilization in case there's any discrepancy between how the market is valuing the asset or in your underwriting versus that of what a lender says. And so in this case, we see that the lender is taking a more conservative approach to valuing the property. And so again, we believe that that's a very helpful functionality to have in this model. And so this gives us the property value at refinance, and the property value at refinance will inform our permanent financing proceeds, particularly through our LTV loan amount. And so the model incorporates 3 constraints when choosing permanent financing proceeds. So we have the minimum debt service coverage ratio and the corresponding amounts for that, as well as the minimum debt yield and the maximum LTV. And so the permanent financing proceeds will be the most conservative value of these 3 loan constraints. And so if we look here, we have permanent financing proceeds to the sum of $6.75 million, and our DSCR loan amount was $6.75 million. So our loan is being constrained by the DSCR loan amount there. Our net loan proceeds will be the amount of permanent financing proceeds in excess of what we need to pay back once the construction loan comes due. And beneath this, we have our assumptions for the permanent financing. So our interest rate, we have the flexibility to incorporate an interest-only period, and our amortization schedule, followed by any loan origination fees or exit fees due at sale. And so moving here to the unit mix, we can input up to 10 different unit types, the unit count for each of the unit types, the square footage, and the monthly rent. And then these are the corresponding outputs. So for example, we have 10 studios at 500 square feet per studio. This results in a total square footage of 5,000 square feet, $2,000 per studio. That results in an annual rent of $240,000. And we have our dollar per square foot amount, and we have our percentage of the total unit. So for example, we have 10 studios and 48 total units. That's 20.8% of the units at the property. We have our development budget here. So we have our major development budget categories. So land acquisition, hard costs, soft costs, and contingency. We can input the corresponding amounts, the start month and the end months, and we can see how our budget looks on a per unit basis, gross square footage basis, rentable square footage basis, and percentage basis. We have our typical revenue assumptions here. So we have rent growth, stabilized vacancy, collection laws, concessions, and other laws. If we want to look at this deal on an untrended basis, of course, we can set the rent growth to 0, and that will allow you to do so. For other income, so our ancillary income, we have 5 inputs available. We can input the values here, and other income has its own growth assumption, so that's separate from rent growth. Then we have our expense assumptions, again, 5 inputs, but we also have management fee incorporated here in case you are paying a property manager. And then we have expense growth based on these 5 inputs here. Right now we're running 3%. We have our value creation summary down here, which is based on the project cost. So we see $171,000, which is coming from here. Our sale, so this is our sale proceeds, which is being informed by this exit cap rate and the NOI. And we have our value creation, which is the delta between the project cost and the sale. And so, for example, if we make our cap rate at stabilization, if we make our exit cap rate if we value the property higher, so drop the cap rate to, let's say, 450 basis points, this, of course, will increase our value creation here. And so the model has updated accordingly. And so development spread we already discussed, but simply put, market cap rate corresponds to the cap rate at stabilization. The development spread is the delta between the stabilized return on cost and the market cap rate. And so adjusting this cap rate at stabilization, we know that this will update this development spread table. In this right section of our operating assumption section, we have our sources and uses table. So we're funding this deal with debt via the construction loan and equity at closing. And we have our total sources, and we can see how our budget breaks out on a unit per unit basis, per gross square footage basis, rentable square footage basis, and percentage of the total budget basis as well. And so we have on the uses side, we have the development budget, any operating shortfalls, so any place where NOI is negative, capitalized loan fees, and capitalized interest, and these are all used to size the construction loan. We have our project timeline, so the major milestones, the corresponding physical occupancy start month, and corresponding dates for each month. We have our disposition summary, which we already saw a bit of here in the value creation summary. And so you'll see these same numbers populating in this chart here. Finally, we have the return summary, so our unlevered metrics and our levered metrics. We see here we have stabilized return on cost, which is populating in this chart here, and the development spread, which is populating in this chart here. And these contributions and distributions are being calculated from the pro forma and cash flow summary here. In particular, row 109 for unlevered and 118 for levered. And so finally, we have our sensitivity analysis table here. So there's no need to adjust the table here unless you want to sensitize another metric, for example. But here we already built it out. So if we choose this drop down here, we can choose between 6 different metrics. So unlevered IRR, equity multiple, and unlevered profit, and then the IRR, equity multiple, and profit, but levered. And so we can choose our center values here. So right now our disposition month is 60, but we can change the disposition month increment as well here. So we're seeing we're starting off in 60, it's going up to 66 and then 72 and so on, in addition, as well as the exit cap rate here, and we can change the increment. And so if we look down here very briefly, these are just our annual cash flows, and this is the output. So everything that we've changed up here, all of our assumptions here are feeding into the bottom half of this sheet here. And then finally, the Calcs tab. Again, this is for auditing purposes, or if you want to augment the model in any way, you can do so by navigating and adjusting this tab. I believe that's everything I wanted to cover with this model. And of course, if you need more robust modeling, or you're looking to observe a specific use case or see how different variables of the deal play out that can't be captured in this model, please reach out to us to begin a formal engagement. We can be reached at ranapropertygroup.com, and we would love to be able to underwrite deals for you and help you deploy your capital effectively. Again, we work across all major asset classes in all markets and across both sides of the capital stack. And so